Now that we have covered the three core patterns, triangles, wedges, channels, it's time to discuss how you can use them effectively in your trading strategy. These patterns provide insights on potential reversals or breakouts, whether the market is moving in a clear trend or consolidating. By recognizing these formations and understanding how the signal changes in market direction, you can plan trades that align with price action and market momentum. Let's dive into how these patterns fit into your trading strategy. The core principle of trading triangles, wedges, channels is to follow the direction in which the pattern breaks. This rule applies regardless of the specific variation, whether it's an ascending, descending, symmetrical triangle, or rising or falling wedge. If the price breaks above the pattern, you would enter a trade in the direction of the breakout, long. And if the price breaks below, you would enter a trade in that direction, short. Here are the various strategic approaches you can apply when using these patterns. Trend plus pattern plus break in the main direction. It's called a trend trade. Trend plus pattern plus break in the opposite direction. Reversal trade. Trend plus pattern plus break in the same direction plus pullback entry. Trend plus pattern plus break in the opposite direction plus pullback entry. Key level plus pattern formation. Key level plus candlestick pattern plus pattern inside. Let's start with the first strategy. Identifying a trend followed by a formation of a pattern and then trading the breakout in the same direction of the trend. This is a classic trend trading strategy. For example, you have a strong uptrend and then a descending triangle pattern forms. While it could have been any of the pattern we discussed, in this case it's a descending triangle. When the price breaks above the descending trend line of the triangle, it signals that the bullish momentum is strong enough to break the pattern and push the price higher. This breakout confirms a trend continuation, and you would look for a long trade on the lower time frame, as the trend is expected to keep moving upward. Let's look at another example. The price is moving in an uptrend and a descending channel forms. Again, this could be any pattern, but here we have a descending channel. When the price breaks above the upper trend line, it confirms a continuation of the trend. You would take long trades in a lower time frame to capture the momentum as the market continues in the same direction. Now, the same logic applies in a downtrend. Imagine you have a downtrend and a descending triangle. In this case, when the price breaks below the descending lower trend line, it signals a continuation of the downtrend. You would look then to enter short trades as the price continues to follow the main downward trend. This approach works both in a bullish and a bearish market and allows you to follow the trend with confidence once the breakout confirms the continuation of the preceding market direction. 2. Trend plus pattern plus break in opposite direction. Reversal trade. Now, let's move on to the reversal trading strategy. In this approach, you first identified the main trend, followed by the formation of the pattern. But instead of continuing in the direction of the trend, the price breaks in the opposite direction, signaling a trend reversal. Let's say you are in an uptrend and an ascending triangle forms. While this pattern usually indicates a continuation, in this case, the price breaks below the lower trend line, indicating a potential reversal. This break in the opposite direction of the uptrend signals that the buyers have lost control and a downward trend is forming. In this scenario, you would look for a short entry as the price breaks downward, confirming the trend change from an uptrend to a downtrend. Now, the reverse applies also in a downtrend. Let's say you have a falling wedge forming in a downtrend. Usually you would expect the price to continue downward, but in this case, the price breaks above the upper trend line of the wedge. It signals a potential reversal from a downtrend to an uptrend, and this break in the opposite direction of the trend suggests that the sellers are losing strength and buyers are stepping in. At this point, you would look for a long entry on the lower time frame as the market shifts from a downtrend to an uptrend. This strategy works both for bullish and bearish market and allows you to capitalize on trend reversals when the price breaks against the direction of the main trend. 3. Trend plus pattern plus break in main trend direction plus pullback entry. Now, let's explore a variation of this trend trading, where you identify the trend followed by a pattern formation and a breakout in the direction of the main trend. But instead of jumping right at the breakout, you wait for a pullback entry. This approach offers a more secure and potentially higher probability trade by allowing the market to retest the breakout level. For example, you are in a strong uptrend and an ascending triangle forms. Typically, when the price breaks above the upper trend line, that's your signal to enter long. But instead of entering right after the breakout, you can decide to wait for a pullback. In this case, after the price breaks above the triangle, it pulls back to retest the breakout level, which has now become a new support. As the price pulls back, several long wick candles appear, signaling that the market is respecting this new level. And additionally, the moving averages crosses this level, creating an area of confluence, which added further confirmation that the support is likely to hold. Once you see an intraday trend change, like the price bouncing off this level or forming a bullish candlestick pattern, you would then enter a long trade. Whether you choose to enter at the breakouts or wait for a pullback, both approaches are valid, and your choice only depends on your trading style and your risk tolerance. It's also important to note that breakout entries and pullback entries requires different stop-loss placements. Understanding this distinction is key in managing the risk effectively, and we'll cover that more in depth in an upcoming video. By waiting for the pullback, you are increasing your chances of entering at a more optimal price, while also allowing the market to confirm the breakout with additional support. 4. Trend plus pattern plus break in opposite direction plus pullback entry. In this variation of the reversal strategy, you first identify the trend, followed by the formation of the pattern. But when the price breaks in the opposite direction of the trend, instead of taking an immediate reversal entry, you wait for the pullback to confirm the reversal before entering your entry. This strategy allows for a more secure entry, as you wait for the market to retest the breakout level. For example, the price is moving in an uptrend with a descending triangle forming. Usually you would expect the trend to continue, but in this case, the price breaks in the opposite direction. It signals a potential reversal from an uptrend to a downtrend. At this point, more aggressive traders might immediately take a short entry at the breakout. But if you prefer a more secure approach, you would wait for the price to pull back to the new resistant level, which used to be the lower boundary of the triangle. This pullback often occurs as a market retests the breakout level. In this case, you would see long, weak candles forming at the new resistance level, which aligns with the bottom of the triangle and where the trend line crosses, creating an area of confluence. This confluence adds further confirmation that the resistance is likely to hold. Once you spot an interested trend change, such as a rejection from previous resistance or a bearish candlestick formation, you would then enter a short trade. This gives you more confidence in the reversal, and the pullback confirms the breakdown of the pattern. By waiting for the pullback to happen, you can reduce the risk of entering too early in a false breakout scenario. Instead, you enter at the market confirms that the breakout level has held as resistance or support in the opposite scenario. This approach works well with traders who prefer to trade with more certainty rather than reacting to the initial breakout. 5. Key level plus pattern formation. In this variation, you combine a key level with a pattern formation. The key level is typically a strong resistance or support level identified through previous price action, such as a significant reversal point. Once you've identified this key level, you then look for a pattern that forms around it, which provides a strong signal of a potential entry. Let's walk through an example. You've identified a key level from a previous reversal point, where the price turned around before. Have the price returns to this key level, a descending channel forms right at this key point. While this descending channel pattern can be any patterns on the list, its formation at this key level strengthens the trade setup. In this case, the price breaks eventually above the formation, confirming a reversal at the key level. This breakout signals that the price is likely to continue upward, reversing from the previous downtrend. At this point, you would take long entries as a breakout from the pattern, combined with the significance of the level, gives you a higher probability of success. By combining a key level with pattern recognition, you're not only trading the pattern itself, but also leveraging the strength of a support or resistance level. This often results in a higher quality trade setup because multiple factors are aligned, giving you more confidence in the potential outcome. This strategy works both for bullish and bearish reversals, depending on whether the key level is at support or resistance, and can be applied to various patterns formed at these critical points. 6. Key level plus candlestick pattern plus pattern inside. This variation takes the strategy a bit further by combining a key level, a candlestick formation, and a pattern inside the candlestick action. This multi-layer approach allows you to identify potential trade entries with a higher degree of confidence. Step 1. Identify a key level. You start by identifying a key level where price action has reacted in the past. In this case, the price is moving in an uptrend, and after breaking a pattern, it pulls back to a newly formed support level. This area of confluence includes a trend line and the new support level, providing strong indication that this level may hold. Step 2. Looking for candlestick patterns. As the price approaches the key level, you observe candlestick patterns forming at this area of confluence. In this scenario, long wick candles appear, showing that the price is reacting to this level, but is temporarily stalling. The candlestick formation suggests that the buyers are defending this area, but price action alone is not yet enough to confirm the trend change. Step 3. Look inside the candlestick for a pattern. Now comes the crucial part. You zoom into a lower time frame to see if any price action patterns, like triangles, wedges, channels, are forming inside this area. For example, you might find a descending triangle forming within the candlestick pattern, right at the key level. This nested pattern gives you additional confirmation that the trend might change. Step 4. Confirm the breakout. Once the price breaks above the inside candlestick pattern formation, this confirms a trend reversal from a downtrend to an uptrend. In this case, a descending triangle that formed at the key level breaks to the upside, signaling a clear shift from bearish to bullish momentum. You would take a long entry when the price makes a higher high, confirming the uptrend. Key point to remember: pull back before takeoff. After the breakout, notice how the price doesn't always shoot straight up. Instead, it might pull back slightly before continuing the upward move. This highlights the importance of waiting for confirmation. 2. Precision stop-loss placement. One critical aspect of this strategy is the stop-loss placement. Understanding this distinction is key in risk management, and we'll cover this in an upcoming video. This combination of key levels, candlestick patterns, and nested patterns inside gives you a layered approach to identifying high-quality trades. It's a more advanced strategy, but when executed correctly, it provides strong confirmation and reduces the risk of false breakouts. If you've enjoyed this series of videos, please give a thumb up, comment, subscribe. We greatly appreciate it. And thank you for watching, and see you in the next one.